Smarter, Smarter quick definitions, long short equity funds. Let's get to the video and take a look. Long short equity funds look to profit from both rising and falling movements in the stock market. The funds will combine both long and short positions in stocks and adjust the gross and net market exposure. With over 40% of hedge funds identifying as equity funds, long-short equity is one of the main hedge fund strategies. The strategy invests in listed equities. The objective is to produce returns via alpha generation with a reduced level of net exposure to the stock market. The strategy is executed by taking long and short positions in stocks and adjusting the fund's net exposure to the stock market depending on the directional view for the market. Long positions are open in stocks that are expected to outperform the stock market in a rising market, and if the stock market declines, these stocks are expected to decline less. Then short positions are open in stocks which are expected to underperform in a strong rising stock market, or for a short position in a stock to actually decline. In order to open a short position, the manager needs to borrow the stock and sell the stock, thus generating cash. Adjusting the level of market exposure is key for long-short equity funds, and there are two methods to calculate market exposure, being gross and net exposure. The gross exposure is calculated by adding the fund's long and its short positions together. The net exposure is calculated by taking the fund's long positions and then subtracting the short positions. Both are expressed as a percentage. A long-short equity strategy is not without risk. One of the key risks is being bought in when a manager must cover this short position, as occurred in GameStop in January 2021. Let's do a quick example on how to calculate gross and net exposure. Both the gross and net exposures are calculated relative to the fund's assets under management. Total AUM 100 million. In the first example, 100% invested in long stock positions. Gross and net exposure equals 100%. Let's just do the quick calculation. So we're looking at the total invested, 100 million, divided by the fund's total assets, 100 million, equals 1 times by 100 equals 100%. I know, it's easy stuff. Let's look at the second example. Long 60% invested in long stock positions, 60 million. Short 30%, 30 million in short stock positions. Gross and net exposure, let's do the quick calculation. So for the gross exposure, we add the exposure together. So 60 million plus the 30 million equals 90 million divided by the AUM of the fund equals 90% gross exposure. Then we look at the net exposure. So we take the long positions, 60 million, minus the short positions equals 30 million divided by the total AUM of the fund equals 0.3 or 30%. The ideal situation is that in a rising market, and assume all stocks go up, the long positions outpace the short positions. The fund is holding 40% in cash, being 10% deposit plus 30% of the fund sold short. Of course, what could go wrong? Well, first off, in a rising market, the short positions outpace the long positions. 2. In a falling market, the long positions fall more than the short positions. 3. A short position needs to be covered. Thus, the hedge fund must buy the stock in the market no matter what. GameStop, January 2021. 4. No real directional movements in the market, and there's a cost of holding short positions. Long-short equity, 3 quick bullet points. Holds both long and short stock positions. The funds will monitor both gross and net market exposure. The fund's success depends very much on the manager's ability to implement the strategy in terms of trading, in terms of stock research, and overall management of their gross and net market exposures.